Alright, so in this video we are going to run through the paper called Deep Value by Cliff Asness and some of his other colleagues at AQR. So what the authors are doing in this paper is exploring the results of deep value events. So those time periods throughout history where the spread between cheap stocks and expensive stocks is particularly pronounced. So let's start digging in. Okay, for table 2 here, the authors are exploring value strategies and returns for different markets. For stocks, we have 4 different regions, the United States, Japan, Europe, and the United Kingdom. And for other asset classes and allocations, we have equity indices, fixed income, and currencies. Now, depending on the availability of data, the start date for each of these asset classes and regions goes back to 1926, 1986, so on and so forth, and goes up to 2015. We also have here the average universe size. So this number here, 3949 for instance, is the average number of U.S. stocks over the 1926 to 2015 time period. The same average number for Japanese stocks, 2489 for European stocks, 773 for UK stocks. And down here for other asset classes, there were an average of 18 equity index futures, 10 fixed income futures, and 10 currency pairs. In their study, they've also split these stocks into intra categories. For instance, with stocks, they've split these total stocks into industries. So 68 total industries make up this whole population of stocks. For the other asset classes, they split them into pairs. For example, for these 18 equity indices, they go long the cheapest one and short the more expensive one for all possible pairs of these 18 stocks. Same thing for the fixed income futures and the currency pairs. So, for instance, since there are 10 pairs here, the number of possible combinations would be 45, and so they're comparing all 45 of those possible combinations. Now, for each of these regions, the average number of stocks within each of these 68 industries is about 77 for the US, 44 for Japan, 39 for Europe, and 12 for the United Kingdom. And obviously for the other asset classes, each of the pairs represents 2, so going long one and short the other. So given these summary statistics here, what the authors have done is rank all of these stocks here by their book-to-price ratios. A high book-to-price ratio would say that the stock is cheap, and a low book-to-price ratio would signal that the stock might be expensive. So they ranked all of these stocks in each region by the book-to-price ratio, and in a mock portfolio, they went long the cheapest stock, cheapest 1/3 of stocks, and went short the 1/3 most expensive stocks. And then they found what was the Sharpe ratio of that portfolio. And they do the same thing in the asset classes, only since there's technically not a book value per se for fixed income or currencies, they have to use a different valuation measure. And for fixed income, it was the real bond yield. And for currencies, it was the real exchange rate, purchasing pricing power, or parity. So for instance, if you're comparing two fixed income portfolios between two countries, if the yield of the bonds in one country minus that country's inflation rate is larger than the yield minus the other country's expected inflation, you might say that the bond in the first country is cheaper because it yields more relative to inflation compared to the bonds of the other country. And a similar situation for currencies and the purchasing price parity. If the price levels in one country are different than what the price levels should be from an inflation basis, there's a discrepancy in the values of those currencies. So now moving on to the results of this particular study, this first column here is the Sharpe ratio using the entire universe. So taking the top third and going long those based on this value factor, and going short the lowest ranking based on this value factor, and we come out to this Sharpe ratio, which is positive in all cases. And then moving to the final column, we have the intra value factor, and this is the results of going long the top third of the securities in each of these intra categories. So within each industry, going long the top third and going short the bottom third based on this ranking. And the same situation for the other asset classes as well, only this intra value factor is the average of all of these pairs, so all possible combinations of each of these here. And what we find is consistent with other prior studies especially in the equity markets, by ranking according to this valuation measure with over the entire equity market universe gets us a Sharpe ratio that's a bit smaller than had we narrowed down our population to within each industry. As we see here, 0.2 versus 0.6, 0.9 versus 1.1, so on and so forth. But that difference doesn't translate over into the other asset classes here. So from the previous table, we saw that buying cheap stocks or other asset classes, meaning those with high book values to prices, outperform those that are more expensive. That is, those with lower book to price ratios. But so now the authors want to see, well, is that outperformance bigger when the spread between the book to price ratios is bigger? So here they've taken the same portfolios that were built in the previous table, and they found the spread between the top third ranked portfolios and those in the bottom third ranked according to their book to price ratio, and grouped the size of that value spread into quintiles each month. So this fifth quintile here is the ones with the highest top 20% of the value spread each month, and showing the performance of going long the top third and going short the bottom third for the following month, and averaging those over all of the months that are in this particular quintile. This number one quintile here is the average 1 month returns for the smallest spread months throughout this period. So looking here at in the stock selection portfolios for the US, we see that during months when the value spread between the cheapest stocks and the most expensive stocks is the highest, we get a 1.2% return by going long the cheapest and going short the most expensive. And also, during months when this value spread is the smallest, we see there's no excess return between the cheapest and more expensive stocks. So in line with what they were expecting, in periods where the spread of the book to price ratio across stocks is largest, the value strategies outperform those when that spread of the book to price ratios is very small. And the authors have also studied and presented the intra-portfolio quintiles. So for instance, with the US stocks, this will be the 68 industries. Within those industries, sorting those by book to price ratios, and going long the cheaper and going short the more expensive stocks. And we see here when the value spreads are the highest, the spread between the book to price ratios of the top third and bottom third is the highest, we get a 1.4% return. And when they're the lowest, we get a 0.1% return. And actually, these returns are monotonically increasing as well. So taking a look at other regions, we have Japan, Europe, and United Kingdom. We see, at least with Japan and Europe, the theory is consistent with the US, where wider value spreads resulted in larger returns. However, these returns aren't necessarily monotonically increasing as they were with the US equities. And the same goes for the intra-portfolio quintiles, which is within the industries in this region. We have much higher returns in the wider value spread areas than the lower value spread areas, but not necessarily monotonic increases with each increase in the quintile. And the United Kingdom is somewhat inconclusive, where actually the widest value spreads result in lower returns than the lowest value spread. So the United Kingdom doesn't really follow the results of the other regions. So it seems like we do have a positive relationship between value spreads and returns, but that's not necessarily in every region. And so if we go up here to this section of the table, the stock selection here combines all of the US, Japan, Europe, and United Kingdom equities and forms the same analysis. And this comes more in line with what we were expecting, with the higher quintile value spreads being higher than the lower quintile value spreads, and with a perfectly monotonic increase in the performance with each increase in the quintile. And the same goes for the intra-portfolio quintiles, and that's the industries. With the intra-portfolio quintiles, we get some pretty significant T statistics here, or about 2, and 1 significant T statistic, possibly a few others. So when we combine all of these regions together, we get a better result, even when it includes the UK, which doesn't necessarily follow the results that we were expecting. So next I have another panel down here for the asset allocation portfolios. This was the equity indices, the fixed income, and the currencies. And here we see somewhat of a positive relationship between the value spread and the returns. of going long the cheapest and short the more expensive. These aren't necessarily monotonic increases, but the top quintiles are larger than the bottom quintiles. And we see the same result over here in the intra-portfolio quintiles, and these are the ones with the pairing, comparing the returns, average returns of each of the possible pairs of the population in each of these. So going back up, we can see the results of combining all of the asset classes together, at least with the asset allocation. This was the one we just looked at with the bonds and the currencies. We see kind of a somewhat of a monotonic increase, and pretty significant t-statistic here. But what the authors primarily want to emphasize here is that when we combine all the asset classes, that means the stocks plus the equity index futures and the currencies and bonds, we get a pretty steady monotonic increase here, a positive relationship between the value spreads and the performance of the value strategies in the next month after the portfolios were formed. Okay, so next, rather than to sort the portfolios by their value spreads, the authors decided to use a regression equation, see if they can create a regression to try to predict what the return of the value strategy, this would be going long the cheaper stocks and going short the more expensive stocks, what would that return be based on it's the value spread at each of those periods, and what would the beta be here. So for instance, they expect this to be a positive value because this would say that as the value spread increases, then they would expect the return to value strategies to increase as well, and because that's what they found in the prior tables. Let's take a look at the results. And indeed, they do find the beta in the regressions to be positive, and it looks like in all cases it's between 0.1 and 0.4. Pretty high one here in the UK. Oh, excuse me, never mind, it's just 2 decimal places. So this is essentially the same table as we saw before, but we have all the combined asset portfolios for stock selection, asset allocation, all assets. We have all the stock selections here with the US, Japan, Europe, and UK. And then here's all the asset allocation, which is equity futures, fixed income futures, and currency futures. And so, as we expected, we see that we see positive betas here. So with each increase in the value spread during that month, that's the spread between the average book-to-price ratios of the highest book-to-price ratios and the lowest book-to-price ratios for all the securities in that month. So each increase in that value spread has resulted in a slight increase to the returns to the value strategies, and that would be the return of going long cheaper stocks and going short more expensive stocks. We also see here some very high statistically significant t-statistics, and in all cases but one, here's the one, I guess, the t-statistics are significant at a 1% level, so we can conclude that it's pretty unlikely that this beta is 0, and that in fact it is there is a positive relation between the value spreads and returns to the value strategies. We also have some R-squareds over here. Those aren't very large, so certainly the return to the value strategy is not just determined or related to the value spreads during that period. There's some other variables in there, but they do have a positive significant relationship here. Okay, so next we're going to take a look at Figure 1, the returns to value investing. And we have here first a couple of charts. So the one on the left we can talk about first. What the authors did is sort the stocks within the intra-industries and regions by their book-to-price ratios and put them into quintiles, so 5 different categories each month based on their rank book-to-price ratio. And so the ones that are ranked 1 are considered to be the value portfolios, and those are the top 5th with the highest book-to-price ratio. We also have down here in the 5th group is the growth companies, and those are the ones with the lowest book-to-price ratio. And on the left side here we have the average returns of those stocks in those portfolios. And what we find is the ones with the highest book-to-price ratios, or the value portfolios, returned the most compared to the growth portfolios that contain the stocks with the lowest book-to-price ratios. And we've got a monotonic decrease here in line with the book-to-price ratios. And so this is in line with other studies, and within this paper, there's a positive relationship between value factors and returns. So over here on the right, they have another figure, and this is an event study. And this axis represents time and months. So at time marker 0, and going back 24 months, and going forward 24 months. And this scale here is the cumulative returns. And we have here in a legend, this blue line here is the deep value portfolios, and that would be the one that have the largest spread between the portfolios with the highest book-to-price ratios and the portfolios with the lowest book-to-price ratios. So you remember from the previous table, we went long the top third book-to-price ratios and short the lowest book to price ratios. And so this line represents the average returns for those deep value portfolios, and these are cumulative returns. So you can see here that before it was put into a deep value situation, this zero cost value portfolio actually had a pretty big loss, down from 0.55 to 0. And then afterwards, it increased to 0.25. So if you had invested at this point, this would be when there would be the largest spread between the value and the growth portfolios. And so that, for this blue line here, we also have the same thing for 2, 3, 4, and 5. And so 5 would represent the narrowest spread, the time periods when the spread between the value and the growth portfolios was the smallest. So what the authors are trying to get at here is that the slopes of these lines are related to the spread, the value spread. So looking at the going forward returns, the time periods where value was the deepest, so the largest spread between the value and growth companies, show the largest returns. And so when that spread is the narrowest, there's not much of a return at all. What they also want to point out is that this increase in return and the spread is pretty much related to changes in price. So before time period 0, these stocks had significant decreases in prices. The long side had a decrease in price compared to the short side, which put it into a deeper and deeper spread state and caused decreases, or caused a loss in the strategy. And so the zero cost portfolios with the deepest spread here happened at a time when maybe growth stocks were increasing in price and value stocks were decreasing in price, causing a loss to the zero cost strategy. Going forward from time 0, the returns are significantly positive, and even more so for the deep value portfolios up for the next 2 years, and there's really no sign that those returns don't continue to move forward after that time period. And also, this one was just stocks. This one down here is for the asset allocation. So this was the equity index futures, the fixed income futures, and currencies. But we see the same situation where the deepest, or the value portfolios, returned more than the growth portfolios, and we see a similar picture as what we saw before, where the deepest value time periods, the spread between the cheapest, and at a time period when the cheap versus expensive securities is the widest, that period showed the largest returns to value, and the time period before showed the largest returns to growth. Okay, so next we got figure 2, and here in the same couple of charts that we saw before, only this time, instead of showing the returns over here, we have risk factors. In this case, it's the market beta. So in the CAPM formula, we're showing here how related are the returns of each of these buckets to the returns of the market portfolio. And so again, we have the value portfolio and the growth portfolio, and then each of the ones in between. And as we would expect, the beta is close to 1 for each of these. However, the value portfolio seems to have a bit higher beta than the growth portfolio, but not by much. On the right side, these again are the zero cost portfolios. So the portfolios from going long, the high book to price ratio stocks, and going short, the low book to price ratios. And again, we have them sorted by the time periods with the deepest value. This is this blue line, and the time periods with the narrowest value spread. Interestingly here, all of these betas are below 0, so we could say that this zero-cost value strategy is a good hedge against market risk. And we also see that the deep value time period showed the most negative betas to the market, and the narrowest value spread showed the highest beta out of all of these, although it's still negative. So I might say the value strategy in itself provides a good hedge against market risk, but the time periods with the deepest value situations had the best hedge against the market risk. Moving down a bit, we have 2 more charts, and these charts, instead of having the market beta here, we have a value beta. So the authors used a global value factor here to see with each quintile of book to price ratios how related are the returns to the returns of global value strategies. And as we would expect, we see that the value portfolio shows a high positive relationship to the value beta, and the growth portfolio shows a pretty big negative relationship with the value beta. And moving over to the right, we have the same situation as before, but with the value beta instead of the market beta. And we see here that, as we would expect, the value beta is positive for all of these portfolios because we're implementing the zero-cost value strategy here. But what's most interesting to see is that the deep value strategy, or the time periods when the spread between the cheapest and the most expensive stocks was the widest, we see more exposure to the value beta. And this certainly contributes to the larger returns during this period. And these were all for stock selection. Moving on down, we have the asset allocation selection, where they did the exact same studies with market betas and the value betas. And we see with the market beta isn't necessarily as conclusive, but we do see that since it's close to a market beta of 1, the returns in each of these buckets is closely related to the returns of the individual markets of each asset class. Moving over to the side, the market betas for the asset allocation, these market betas are pretty close to 0, so unrelated to market returns. Although we do see that the deep value time periods are a little bit more negative than the narrow value time periods. So moving on down, just like in the previous part, we have the relationship with the value beta for the asset allocation strategies. And we see, as we might expect, the portfolios in the more value bucket end up with a greater beta relationship with the value beta. And the growth portfolios have a significant negative beta in relationship to the global value factor. And just like we saw with the stock selection category above, we also see the same thing with the asset allocation study, where we have the deepest value time periods show the most exposure to the global value factor for the asset classes, and the narrowest time periods of the value spread shows almost a 0 relationship to the global value factor for those assets. So that's why they don't get as much of a return to value as the deep value ones do. Okay, so let's move on to figure 3 here. We're going to be looking at the earnings fundamentals of value. So we've got a couple charts here, as we did in the prior figures. The first one here shows the return on equity for each of the quintiles book-to-price ratios. And we see the value portfolios, the ones with the highest book-to-price ratios, exhibit the smallest return on equity compared to the growth companies, which have the largest return on equity, and that's well known throughout other studies as well as this one. But what's really interesting to see is this event study chart here that shows the return on equity for each of the levels of the value spreads. And as we had in the prior figures, we've got a time 0 here that shows 24 months before and 24 months after, and a cumulative return on equity figure over here on the scale. And so we see that as time goes on for these particular zero-cost value portfolios, the return on equity steadily decreases, and this is even more pronounced for the deep value time period portfolios because they're decreasing the most, and the narrow spread time periods decreasing the least. And so I want to make it clear here that since these portfolios are the zero cost going long the value companies and going short the growth companies, this graph shows the evolution of earnings for the value companies minus the evolution of earnings for the growth companies. So this decrease means that the growth companies have larger return on equity than the value companies in these portfolios, and that's why we've got a decrease there. So let's go down to earnings forecast revisions. And since we've seen with these charts up here that the decrease in price leads the decrease in earnings, it seems only fitting that the earnings revisions of the analysts should follow suit. And so we see that with value portfolios, the analysts revise earnings downward, so we have a negative figure here, a lot farther than those of growth companies. And so moving over here, since this is the zero cost value portfolio and we're long the value and short the growth stocks, this figure is the revisions of the long stocks minus the revisions of the short stocks. So we see here deterioration in the earnings forecast revisions due to the revisions for the value companies decreasing. And this decreases until about a year after time 0. We start to see a reversal where the value stocks start to see positive earnings revisions relative to the growth stocks in these portfolios. And interesting, the deep value time periods show the most pronounced cycle here. So next we take a look at investor sentiment relative to the value or growth status of the securities in the portfolio, and that's at figure 4. So here on the left we have a scale of news sentiment, so how positive or negative is the news for the particular quintiles of value up to growth, and an amount of about 50 is neutral sentiment, and greater than 50 is positive sentiment, and below 50 is negative sentiment. So we do see that monotonically the sentiment for these quintiles increases as we come into more growth-related companies. So the value portfolios or the securities within them are getting hit the most on sentiment. But what's really interesting to see is this line chart here that shows the sentiment level leading up to the value formation and then 2 years after the value formation. So we see leading up to the point at which the portfolio is invested or the value companies are, or the value portfolios are performed, we see a significant decrease in sentiment. And so that's the sentiment of the value companies minus the sentiment of the growth companies in these portfolios. And so this will mean that the value companies are becoming less and less in favor as time goes on relative to the growth companies in that portfolio, the long and short side. But then shortly after the value formation, we see a huge upshoot in the sentiment between the value and growth companies. So the value companies become more and more in favor relative to the growth companies. And that's maybe why we see excess returns to value. And interesting, the deep value portfolio, so the time periods when the spread between the value and growth companies is the largest, we see the biggest change here in sentiment. So the largest slope in these lines. So next here in figure 5 we have demand pressure. And so what we're looking at here is out of all the purchases and sales of these securities in each of these quintiles, what percentage were buys and what percentage were sells. And since all of these are positive, there were more purchases than sales in dollar value. We do see, however, that there's more buying pressure for growth stocks than there are for value stocks. So it's maybe more demand for the growth stocks than value. And this is a pretty monotonic relationship. So looking over here at the line chart, we remember this is the long minus the short in the zero cost portfolio, so the value minus the growth. And so we see here a decrease in the demand pressure, so a decrease in the percentage of buys to sells, and the difference of those between the value and the growth companies. So over time, there is a continuous stream of more demand for growth companies than value companies. And this continues from 2 years before to 2 years after the advanced study, and it's certainly more pronounced in deep value time periods, this blue line here, than it is for the narrow spread time periods. So when the value stocks become really, really cheap, some investors run to the exits, and that's kind of consistent with a lot of the behavioral models here. So in the previous tables, we saw that value stocks tend to have more of selling pressure than growth stocks, and also the returns to value stocks tend to be decreasing as compared to growth stocks. And so here in table 5, we're going to look at what are investors over and underreacting to the result and the changes in demand and returns for value and growth stocks. So let's go down to the table here. What we have here is 2 different sets of regressions, well, several, but 2 categories here, 2 different dependent variables. And the dependent variable here is the demand pressure, so the dollar buys minus the dollar sells. And the other dependent variable we have is the 1 month ahead returns. And so for each of these dependent variables, we have regressions of the prior returns only, the prior return on equity only, and then both of them together. And this is for both of these dependent variables. And we have different time periods as well. So in this particular study, we want to see, are investors reacting to past fundamentals, for instance, the return on equity, or past returns? And for the time periods, we're looking at the past year or the past 5 years, because these are in months. And so we see here that since these coefficients are positive and have very significant t-statistics, we see that when taken into isolation, the past returns as well as the past fundamentals, the past return on equity, drive the 1 month ahead demand pressure positively. So the higher the past returns or the higher the past return on equity, the higher the demand pressure. However, when we put them together, put the returns and the return on equity together, we find that only the returns piece is positive and significant. And so this might mean that past returns and past return on equity are somewhat correlated. And so whenever controlling for one or the other, we get that the past returns subsume the past fundamentals. So this is consistent with theories of the over-extrapolation of past returns, but not the overaction to past fundamentals. And so let's go over here and see how do past returns and past fundamentals predict the 1 month ahead return. So we see here that recent past returns predict the 1 month ahead returns positively, consistent with the momentum effect. However, the long-term past returns predict the 1 month ahead returns negatively, consistent with a reversion to the mean and maybe overreaction to those returns. And the ROE column for the fundamentals, we see that past returns on equity do not predict the 1 month ahead returns, because we have 0 here, and very insignificant t statistics. However, when we control for the past returns, so when we see whenever we combine them both into this regression, when we're controlling for the past returns, we get some positive predictions of the 1 month returns based on the prior fundamentals. So this is consistent with evidence of other studies that investors underreact to fundamentals, resulting in positive returns going forward, and they overreact to short-term past returns, which leads to short-term momentum gains but reversals later on. And this may be what creates the value effect. So now that we understand some of the drivers of the returns to value, we want to look at why maybe the mispricing is occurring and is persistent through the limits of value arbitrage. So we want to see, are there costs or other hindrances to investors putting the value and growth companies more in line with their intrinsic values. And for that, we have a couple figures down here. The first one shows the bid-ask spreads by quintile of book-to-price ratios from value to growth, as we've seen before. And we see that the bid-ask spread for value companies is much larger than the bid-ask spread for growth companies, and to the quintiles in between. And so that would say that it's particularly costly to trade in these value companies here compared to the other quintiles. And we see over here at this line chart that the bid-ask spreads between the value and growth companies, as if you were going to utilize this zero-cost strategy of going long value and going short growth, we see that the bid-ask spread between those is particularly large during deep value events, so time periods when the spread between value and growth is particularly high. And that might contribute to the persistence of value returns because it's particularly costly to implement those strategies compared to lower value spreads. So going down to the next group of figures, we have the short fees relative to the different quintiles of book-to-price ratios. And we see that the value portfolio's shorting fee and the growth portfolio shorting fee is a lot higher than that of the ones in between. So it's a lot more expensive to short value or growth. And so that would make it pretty difficult and costly to implement the strategy of going long and short the other. And going over here to this line chart as well, since the strategy is to short growth companies, this chart shows the shorting fee for growth companies over the time period from negative 24 months to positive 24 months. And we see that in deep value events, this blue line here, when the value and growth companies are particularly pronounced, it's a lot more expensive to short the growth companies. And so that's another hindrance of correcting the mispricing between value and growth companies and the value which may cause the persistence of the value strategies earning excess returns. So going down a little farther, we have the level of volatility relative to each quintile of book-to-price ratios, and we see that the volatility of value companies is a lot higher than the volatility of growth companies. And so going over here to the line chart of implementing the zero-cost strategy, we see in deep value events and time periods when the value and growth companies have the largest spread of book-to-price ratios, we see that the volatility in that strategy is much higher than the volatility in the smaller spreads between value and growth companies. So deep value events present value arbitrageurs a lot more volatility and a lot more risk, which would take a hit to the Sharpe ratios of implementing those strategies. So these three sections here present different reasons for why the value strategies might persist and why it's difficult to bring the prices of value and growth companies to their true relative intrinsic values. So next, in further analysis of the arbitrage of value companies relative to growth companies, we'll look at figure 7 that shows that maybe could it be the companies themselves that are buying back shares, or maybe other acquirers that are taking advantage of the deep value events. So let's go down here and take a look at some of the figures. So first here we have the short interest at the different quintiles of book-to-price level. So the author's initial thought is that if we're going to implement a value arbitrage strategy, we would go long the value companies and go short the growth companies, but we see here that that's not necessarily the case because the value companies have more short interest than do the growth companies, although both of these extremes have more short interest than the interior quintiles. So moving over here to the event study chart, this is the short interest 24 months prior and 24 months after time zero for the growth companies. So we would think that if a value arbitrage strategy was occurring, investors would go long value companies and short growth companies. So this chart shows just the short interest for the growth company. And as would be expected, the growth company short interest is much larger than the other spreads of value between value and growth companies during the different periods. And this occurs for a couple years after the portfolio formation. What's interesting to see is there is a slight decrease of short interest shortly after the portfolio formation, and authors think that maybe the investors have been in the short position for a while and has eventually made them either get margin calls or have to reduce their positions in some way before they're able to start shorting more. But these short interests do seem to be very elevated for the more deep value time periods. So going down, we're going to see are the firms, the companies themselves, the actual arbitrageurs of last resort. And so we want to see are these companies buying back their own stock in an effort to arbitrage the cheaper securities. And so this shows the negative of the number of shares outstanding for the companies in the different book price buckets from value to growth. And so a negative value here would mean that shares are being issued. And we see in all cases there's a monotonic increase in the number of shares issued as the quintile level increases. So growth companies are issuing more shares than value companies. So going over here to the event study, this is the net buyback difference between the value and the growth companies in each of these zero-cost portfolio strategies. And we see that definitely after the portfolio formation date, the value companies are buying back more shares compared to the number of shares that the growth companies are buying back. And that's in all cases, all deep value versus narrow spread value situation. But definitely in the deep value case, more value companies are buying back shares than growth companies are. And finally, let's go down here to these charts that show whether acquirers are the ones that are arbitraging the value growth difference away. So this is the percentage of stocks that are bought back or purchased by the acquirer and absorbed into their company, so actually delisted from the exchange. And we see that value companies have a much more likelihood and prevalence of being acquired than do growth companies. And moving over to the event study, this is the probability of being acquired for the value companies minus the probability of being acquired for the growth companies. And we see that after the portfolio formation and all levels of value, the likelihood of a value company being acquired as opposed to a growth company steadily increases over the next 2 years. We also see that this is more pronounced in deep value events as opposed to the narrow value events, signaling that acquirers act as the arbitrage last resort. So they go in and buy these value companies who may be significantly cheap and undervalued. So now that we have an understanding of some of the drivers of these value strategies, we're going to look at some out-of-sample strategies to see how might these value portfolios have worked during deep value scenarios. And so what they've done is starting in 1976, they show or they record the value spread between the value and the growth companies in their zero-cost portfolios. And once that spread gets to the 80th percentile, they buy the value portfolio, and then they sell it, they hold it, and they sell it until that spread gets down to its median level. And that's with the information they have up until that point since 1976. And this goes all the way to present. So let's see the results down here. They do it for each of the portfolios, so the stock selection portfolios, asset allocation portfolios, and then all of them together. And in doing so, they're looking at the loadings for common factors, so loading on the market return, a value factor, and a momentum factor. We see here in all cases, certainly the value factor gets the most loading, and that makes sense because that's the types of portfolios that we're forming here. So these deep value portfolios are loading significantly on the value factor. Also, we see a somewhat negative momentum factor on these. And this makes sense from what we saw in other tables that the value companies tend to have negative past returns. And in these cases, the loading on the market and even the alpha is somewhat insignificant. And so this would mean that trying to time the value factor, for instance, only invest in the value factor when there's deep value events, would not be an appropriate strategy because you're just going to get the level of the value factor there in your returns, and really nothing else. However, when we pull all 7 strategies together over in this all column, we see that there is a significant alpha there. So maybe something to the diversification over all of the strategies during deep value event. And this is even more pronounced when we go down here and we look into the intra value strategies. So if we remember, this was with the stock selection, this was the 68, investing in the 68 different industries according to the value spreads. And then with the asset allocation, it was looking at the pairs of the different index futures, and then we have all of them together. And within each of these, we have similar situations as to before, significant loading on the value factor, and also negative loading on the momentum factors, but not really a significant alpha or market exposure. However, once we combine all of those together, we do get a pretty significant alpha here. And we also have some pretty significant R squareds here, so these different factors explain a significant portion of the variation in returns. All right, so next in Table 7, the authors develop different parameters or thresholds for when to enter and exit the value portfolio, depending on the level of value spread. And they've pulled in the same results from the prior table for the deep value, where they went in, or they bought the value portfolio at the 80 percentile, and then exited once it got back to the median value up until that point. They've also implemented a deeper value measure, and this means they're entering into the value portfolio when the value spread minus its median value spread up to that point divided by the standard deviation of the value spreads exceeds 2, they enter into the portfolio. So that would signal that the value spread is significantly deeper than normal, and maybe a more strict entry point than just the deep value. And they exit the portfolio when that value gets below 1. And for the threshold portfolios, they enter and exit the value portfolio when the value spread exceeds 80%. So that's for both the entry and the exit. And then the linear is by adding or removing risk as the value spread expands or contracts. So more of a fluid, dynamic allocation to the value portfolio. And so we see in all cases, well, this is from the prior chart, where we saw significant loading to the value and also significant loading to the alpha and a negative to the momentum. And this is continues on into the other measures of value as well. And certainly the deeper value strategy yields a larger alpha than the others. So being more selective for when to enter the value strategy depending on the value spread may be a good play. So given those results, they come down here to another table where they show the results of the interest strategies of stock selection, asset allocation, and then all of them for each of the strategies. And consistent with the panel B of the prior table, we still see significant loadings on the value and negative loadings on the momentum factors, and they're somewhat significantly related to the standard value timing as well. But this still leaves a pretty significant alpha here. So next here in Figure 8, the authors quantify the number of trades in the deep value strategy. And so this is for the stock selection industries and the asset allocation pairs. So going down to this chart, we see this green line is the number of trades for the deep value strategies that we just showed. And so we've got some more deep value events, 2008 and 2001 recessions, and also back in the Volcker experiments back in the 80s, maybe the first invasion of Iraq here in the early 90s, and the European crisis in 2012. And so these were times when value companies' book-to-price ratios significantly exceeded those of growth companies, and maybe present opportunities for taking advantage of a value strategy. And so looking at the cumulative returns, we can see that the deep value strategy tends to do pretty well during periods of deep value events. We've got a large run up here and here and here and here and here. All right, so given that the number of trades clusters around deep value events, possibly global events, the authors here have done a regression of what are the returns, volatility, and Sharpe ratios as there are more trades to be made, for instance, the ones that qualify as being deep value across the different opportunity set. And so we see here's the all asset portfolios, and then stock selection and asset allocation. And we see certainly that when the opportunity set increases, so do the returns, as well as the volatility, and ultimately the Sharpe ratio. So as would be expected, as there are more deep value events and within industries or asset classes or pairs, we see higher returns for the portfolio. And of course, we're making more trades, we get more volatility as well, but those returns far outstrip the volatility and give us a higher Sharpe ratio.